It does bring us to our talk of the tape, the best start to earnings in some 20 years, and whether a huge week ahead can hold the momentum. Let's ask Adam Parker. He is the founder and CEO of Trivariate Research, a CNBC contributor. I mean, we have been off to a good start so far. Banks, gave a little love rather than the opposite. You feel any better than you have?
Well, it's one of those, if I told you were going to make a bunch of money and then I told you a couple months ago it'd be a lot less and I beat that lot less by a little, I guess you're okay. I mean, the earnings revisions during the first quarter were down in every single sector of the market, down 6-7% from Jan 1 to March 31st. So they're clearing the lower bar, but I wouldn't say, all clear signal earnings are great. I think it'll be mixed, and I think the big investment debate is how much of the Fed action is already in, or has it even started? And all that, what I think is more the case is we had a big sort of reopening and unwind of the reopening, and I think now you're about to see the lagged effect of the Fed action. So I'm in the camp that earnings are going to come lower, probably much lower for 2024 numbers than we have.
Okay, so you're in the Mike Wilson, Morgan Stanley.
I mean,
camp.
He's in my camp, I'd say. Let's phrase it that way.
Okay, I figured you were going to go there. But the bottom line, though, is that you still think, and those who are more cautious still think, that earnings expectations are too optimistic.
Yeah, I do, but I don't know if that always matters, as you know, for whether the stock market goes up, right? So,
well, what do you make of that then?
I mean,
right? Because the market, I think you can also admit, has been pretty darn resilient.
Extremely resilient, and I think there's three reasons for it if you take sort of the growth part that's leading. One is, this perception the Fed got dovish and inflected. You see that in the bond market. You see it in growth equities. Right, you see it in semiconductors, et cetera. Two is something that I think is probably real, which is AI. The parts of AI that are real, they're going to drive very rapidly some big changes. And so there's real fundamental reasons why NVIDIA is up. It's not all the Fed. And I think the third is sort of the relative defense people perceive about the big FANG M stocks, that basically if the overall estimates are way too high, maybe there's some defensive in there. So some logic why that part's led and outperformed. But I don't think it's an all-clear signal that this guy, whatever. I think the earnings will decline. And right now the estimates are $219 or so for 2023, $219, $246 for next year. I think that the better number for next year is probably more like $220 or $225. So you still have some real revisions for 2024 numbers.
So let me ask you this. Do you think, because I've had this debate with others, about whether a recession is priced into the market, okay? Marko Kolanovic of J.P. Morgan, whom we follow, and he publishes a lot in the mid to late afternoon, literally just dropped a note, okay?
Right.
With some pretty provocative thoughts in here, and I want your reaction to them. Even in an optimistic scenario of soft landing, equity upside is likely less than 5%, and that is the return that is delivered by short-term fixed income. That's number one thought. Number two, on the downside, even a mild recession would warrant retesting the previous lows and result in 15+% downside. 15% downside, even if it's a mild recession. You agree with that?
I'm kind of halfway in between here and that. I'd say, the market really has been kind of range bound. 3,500 was the low, plus or minus 4,200 the top. Whenever we get clear to the top of the range, I get a little bit more worried. I have some sympathy for the fact that maybe, we just haven't seen some of the lagged effect of the slowdown in earnings yet.